Hello, everyone. Good afternoon, and thank you for joining us today. My name is Namir Hallak. I'm a cross-border tax managing director with Andersen, based here in beautiful Vancouver, and I'm joined with my colleague here, Savneet Talwar.
Hello, everyone. I'm a managing director with Andersen as well, and we work very closely with each other.
Yeah, and Andersen is a global tax and legal advisory firm where, if the name sounds familiar to you, it's an evolution or rebirth of Arthur Andersen. Andersen today is in 183 countries. We are also one of the largest cross-border tax specialists here in Canada. So today's session, where is Krista? Oh, there we go. Thanks, Krista. So today's session is, designing global startups, structure, scale, wealth. So the core idea behind this is where you build your global business shapes what you get to keep here at home. So when you're running your business, whether it's the profits you're having currently as you're operating the business or the profits you're going to get when you exit the business, you want to find ways to plan for it early so you're preserving the wealth that you are building. What Savneet and I want to do for you today is we want to bring together some of the conversations we hear from founders, from owners. What are they missing in their process of building and growing their business? And the thing is, when you talk to founders today, they're quite busy, and they're busy doing the right things, thinking about, how do I grow the business? How do I get the right customers? How do I find the right product market mix? What is my AI strategy? Am I hiring the right people? And those are all really, really good questions. But very few founders pause to think about, do I even have the right global corporate structure? As you're developing your business, as you're building your business, do I have the right IP positioning, your intellectual property? So where are you building that intellectual property? Where are you developing that value? And how are you trying to preserve your wealth that you're building in this business, the value, long term? And the reason those decisions matter is it'll ultimately shape who owns your business, who is controlling your business, what kind of investors and buyers you're attracting, where are they on the global markets, and ultimately, how painful or rewarding not only will your growth and expansion be, but ultimately your exit. And will you be able to preserve your legacy, the wealth, and the value that you've built in that business? And look, we've seen some incredible founders build some really interesting, great businesses. But the challenge is a lot of times they find themselves creating these unnecessary tax exposures or unnecessary burdens administratively where they're compiling their tax returns and regulatory agreements across all these different jurisdictions. And the real risk these businesses have is when they eventually do an exit or a sale, they might be exposed to a very expensive restructuring and an administratively headache-filled exit when they ultimately make a sale. And this, go ahead.
I was going to say it's better to do things right now instead of trying to unwind it later because it's costlier to do an unwind rather than do it right the first time.
Yeah, and the thing with tech, in the tech industry is you're most likely going to start being global very early in your company's story, right? If you are a business that is selling to US customers and you have engineers or data scientists in other countries and you're looking for investors or you're looking for a round of financing in Europe, you're already going global from very early days of your business. And the reality is a lot of the legal and tax systems in all the different jurisdictions you're working with, they've been built on a bit of an older system, where you have a traditional factory or you have a brick and mortar store or you're selling a physical, tangible good. And they're evolving. The legal and tax rules are evolving to catch up with the economic realities. And with that, we want to catch you up today as well. So with that, we'll start with an example in the US, how to scale into the US. We'll go into, can you go back? Sorry. We'll talk about how to design a scalable global structure, how to fund your global expansion, where value and wealth is created. Why does that question matter so much, and why do you have to ask these questions very early as your business is evolving? What are investors and acquirers looking for when you do that ultimate exit? What are they actually looking for? And then finally, how do you design a durable structure that'll allow you the flexibility to grow.
Okay, let's dive right in. Let's look at, can we switch the slide, please? Okay, scaling into the US. So you might already be taxable. So if you have customers there, clients there, or you have a contractor there, you might be actually taxable in the US. So before we go into what is taxability in the US, let's switch back and think about what creates a US trade or business. The US trade or business it's a very low threshold. So it's anything continuous, considerable, and regular. So you might just have one customer there, but it doesn't mean you don't have to pay taxes in the US or you don't have to do a filing in the US. So just having a little bit of activity in the US can cause a filing. And that's what is US trade or business. And the next threshold that we look at is permanent establishment. So essentially, if you have an office there or a place of business or a person working from home, that could cause a permanent establishment. And a permanent establishment is defined in the treaty between US and Canada, right? And so if you think big, what does US trade or business cost? Having a US trade or business, which is the lesser threshold, actually causes a filing in the US. Having a permanent establishment in the US, on the other hand, might cause you to be taxable in the US. That means you might have to pay tax. So the fact is you still have a filing, even though you might not be taxable, which is a very, very important thing to note here. And if you don't do that filing, again, US is known for as penalty, so there could be a $10,000 penalty for some firms, there's a $25,000 penalty, and then there are penalties on top of penalties. So something to be aware of. So get your filings right. When you think about structure, you also think about filings at the same time. And what does it mean for money getting out of your pocket and going into the IRS's pocket, right? And then states. Every state in the US is like its own country. I always say this, there are 51 countries. And so on the federal side, the treaty between, so as an example, the treaty between US and Canada defines whether you're taxable from a federal perspective. But when it comes to states, some states are like, I don't care about your treaty. I'm going to still tax you, right? And that is the important thing to note. So if you're going down to the US, which state are you going to do business in? What does it mean from a income tax perspective, a sales tax perspective, or a payroll tax perspective? So super important. So there are a lot of things that can trigger a filing in the US.
Yeah, and when you think about also like a SaaS business, a software as a service business, for the longest time, and we'll use here the US as an example as kind of one of the case studies, for the longest time, they were working under old traditional rules. Again, do you have a tangible product? Do you have, factories? And so it was a bit of a gray area for a SaaS business to understand. Let's say you're headquartered here in Canada. Am I even going to be taxed in the US? It's not a tangible good. It's a service that I'm providing. Maybe it's a subscription model. And as we started out this conversation by saying, the rules are evolving. They're trying to catch up with the economic realities of how businesses are transacting with customers, even for never ever stepping foot in that state. So for example, in 2025, so last year, early in the year, the US issued proposed rules that is changing how, for example, cloud transactions are taxed at the federal level. So now they're looking at, how do they characterize that income? How are they then eventually going to source that income? Is it even, does the US get first dibs to tax it? And eventually, how does that get taxed? And of course, when you look at the other 50 states, each state will have different rules of same thing. How am I going to characterize that income? How am I going to source that income? Is it going to be sourced to that state? And ultimately, is it even taxable?
Yeah, and I think just to add to that state piece there, so some states treat software as a tangible property, right? Because you're usually delivering a software online. And they say it's like a tangible property, which means you're buying something that is already packaged for you, right? And some states say, no, you're actually customizing, so it's actually as a service. So it's an intangible or treated as a service. So they get taxed separately in different states. So it's not only important to look at the state where your customer is, it's also important to look at, say, you're doing the work in one state. So you need to think about the larger effect and what this means for you, because software can get taxed differently in different states. That might mean you're probably paying the tax twice in some states, in 2 states, or you're not paying it at all, right? Because the rules of sourcing are different.
And they're looking more and more, and you'll hear us use this term throughout today's talk, is where are you actually generating value? What are the activities that are happening across your Canadian entity or a foreign jurisdiction entity that is creating value for you? That is how the state's going to come back and say, is the income going to be sourced to that state, and then same with the federal. And keep in mind, with states, a lot of times you hear Canadian companies or other foreign companies say, well, I'm protected by the tax treaty. If there's, for example, U.S. Canada have a tax treaty that is very close to the OECD model treaty. And so that's considered, great, I can do a lot of these activities and I am going to be protected from being subject to U.S. federal taxes. Well, you have a lot of states that look at that and say, well, we're not going to adopt that treaty. That's between two federal governments. And so you have to be mindful of all the different jurisdictions. And I would say even more than just the 50 states, you have other jurisdictions at the state and local level, which are counties and cities and towns, and they also have their own tax rules that you have to be cognizant of as well.
Yeah, doesn't sound complicated at all, does it? It does. So
Oh, I think...
you skipped a slide. Yeah.
Awesome. So I think when technology companies are then looking to enter into the global market, I would say one of the first critical questions that comes up is, and it's a very consequential one, how do I structure my entry into that market? What does that look like? And I would say the first obvious choice they're going to ask is, can I operate directly from my current existing entity? Can I operate and do business in that foreign jurisdiction, if it's the US, if it's Europe, if it's South America? Can I operate from my existing entity? Or do I need to establish a foreign subsidiary or a foreign entity? Do I need to create a whole different legal entity to do business in the other jurisdiction? And that decision has a lot of far-reaching, not only compliance consequences and tax consequences, I mean, that's pretty obvious, but it actually impacts your investor's perception of the business. It impacts whether you're able to scale the business. So where you are in the company's life cycle will drive what's the right answer for you. So if we go through that first example of, okay, well, let's say I want to operate for now directly through my home, let's say Canadian entity. At first glance, this is really simple. You don't have to do any major changes here. You already have a legal entity. You could probably contract with customers in different jurisdictions. You can maybe even hire foreign talent pretty quickly through that existing entity. So that can work, but that also comes with a lot of risks, just like Savneet mentioned, where you might have filings and tax exposure for that existing Canadian entity in foreign jurisdictions.
So just to add to that, now think about the people who are working with you, your customers. Do they rather work with a company that is headquartered there, or would they want to work with a company that's headquartered in another country? So for them, it wouldn't matter. But now, what the new rules, sorry, not the new rules, but the withholding tax rules make it really complicated for them. So as an example, if a Canadian company has a U.S. customer and the U.S. customer is paying a Canadian company, there might be withholding tax issues. So now you're having your customers do more filings, and they wouldn't want that. So it also depends on whom you're working with. And it's really important when you have a Canadian company that is actually working in other countries, because your customers might have to do additional filings as well.
And there's different levels of taxes, right? So there are the income taxes, kind of the traditional taxes we think of. There's also sales taxes, there's the VAT taxes. You also, if you're hiring foreign talent, you might be subject to payroll withholdings by that Canadian entity. So you're creating, it is simple for now, but it does create a patchwork of headaches for you from a compliance perspective. So then the next model you get into is, well, what about if I create a separate entity? And I would say if you're a tech company that's very serious about, going global, then you have ambitions more likely that it's going to require something of setting up a foreign entity, likely a foreign subsidiary. In the US, a common structure that is used is a Delaware C Corp. And what happens when you have, for example, a corporate entity that's separate from your existing one is you're essentially ring fencing any activities that are happening outside of your home jurisdictions, outside of Canada, for example. So it's all delineated to that other entity that's set up. And that also means that, from a liability perspective, if there's any litigation that comes up, it's going to be ring-fenced to that other entity. If you have any other sort of exposure that comes up, whether it's taxes or otherwise, again, it's going to be ring-fenced to that other separate entity.
So as an example, if there's a Canadian company and it wants to do a business in the US, it actually sets up a US corporation. And so if there's some liability that the US company has, it gets restricted to that entity's level. It doesn't affect your Canadian company. But whereas if the Canadian company was directly doing business in the US, then that Canadian entity will get affected, and whether it's all its business in Canada as well. So you're trying to separate out the liability as well.
Yeah, and when you're dealing with, because very soon as a tech company, hopefully, you're trying to scale the business, you want to grow the business. Very soon you're going to be dealing with, venture capital and institutional investors. That's going to more align with their expectations. They're going to expect that they're dealing with, and they prefer to deal with, for example, a Delaware C Corp, than when dealing instead with a foreign to them, a Canadian entity. So, and it's also, by the way, when you set up that separate entity, it also is a model that's easier for you to onboard employees, or also if you're contracting with customers. And even just answering to what Savneet said earlier, I mean, a lot of American vendors or customers will say, we want to, buy in America or buy in the USA. So that label can be done by having, for example, a US legal entity. I mean, there's other considerations there in terms of the value chain and how much of the product is actually fully US or not. But it really is a very critical question very early in the company's life cycle. And I'll tell you that one question that comes up for us often in this, from a lot of our founders and owners is, well, can you just give me the right structure? Like, what's the right structure to do business in whichever jurisdiction? Can I just do business in this one way? Or my friend or my cousin or my neighbor has done it this way. Will this work for me? And you probably, as you're used to hearing this from lawyers and accountants, there is no one size that fits all. There is no one answer that's going to work for all your facts and all your circumstances. There's a lot of questions that go into it. And some of it seems logical. I want to know, where is your business going? Where do you project the growth to be? Where are you going to have some of the key functions and strategic decisions being made? And then ultimately, how will you exit the business? You have something to say.
Yeah, just to add to that, where do I want my profits to live? So if I'm earning income, right, do I want to keep it in the US? Do I want to get it back to Canada, right? What is the purpose of, how do you want to deal with the money? Do you want to get money to Canada so you can invest in Canadian businesses, or do you want to keep it in the US and maybe try and diversify there or put it into the growth of the company? So at the end, it depends on what your aim is and where do you want the money to live, and where does it work best for your business.
And have these, conversations. If you're more than one owner, if there's a team of owners or there's a team of investors, have these type of conversations where you're asking yourself, what are we really doing in this market? Are we just testing a foreign market out? Are we just dipping our toes in just to figure out if this is the right product market mix? If that's the case, you could probably operate from your home entity. You could probably use your existing legal entity. It'll work for now, temporarily. But you just need to be aware of those risks. Now, on the other hand, if you're saying we actually plan on hiring some foreign employees, we want to raise US capital, we might be bringing in investors from other jurisdictions, US or Europe or otherwise. If you're going to attract those investors, or you want to scale quickly, then you really need to be thoughtful about, probably need to get a separate entity. That's usually, almost always, the better choice. So you want to build that right structure from the outset. I will tell you that, again, because I think founders should be really focused, go build your business, go build this incredible idea that you have. But be mindful that you don't want your business to evolve quick enough that you haven't actually thought about this structure early. Because when you decide you want to have the next chapter for your business, whether that's an exit, an acquisition, or maybe you're scaling out to several different jurisdictions, trying to restructure it later, where you've already developed value, can be really expensive. And if you have...
Yeah, so I just wanted to add a little bit to that. And when you think about structure, there are things that you need to be wary of. Like, there are structures that are not good for Canadians,
right,
but might work for, say, Americans, right? There are certain hybrid entities which get taxable, which get taxed as maybe a corporation in one country and a partnership in one country. So you don't want to be in those structures because you're going to end up paying double the tax, right? So it's super important. Before you think about a structure, you need to talk to a cross-border tax advisor who can make sure you're not in those structures where you're paying double the tax.
And it's funny, I had a conversation last week with a founder. They were also in the tech industry, and they were telling me, because I was asking them, again, they're thinking about overall their corporate structure globally. Do they need to set up another entity? And he's like, well, you know what, Namir, I don't need to worry. Right now, I don't have any IP. I don't have any intellectual property. It's just, we have a great bunch of customers. We have this great idea where, and they've actually, they had significant revenue already developed in the last 12 months. And my argument to him was, I don't think your company's worth zero. if that's what you're saying. I think there's actually some value to your intellectual property, which, again, in the tech industry, one of your core assets usually is your intellectual property. And that could be many things, right? That can be your process, that could be your algorithm, that could be your customer list, whatever it is that's creating value for you. And if you have to restructure your business from a corporate, from a legal perspective, from a tax perspective, there is usually a adverse tax consequence, a very expensive one, to then expatriate your intellectual property out of the existing legal entity. Again, depends on how much value is there, but if it's, if it's a hockey stick and it's going to continue appreciating in value, you need to make those decisions early. Where do you want your intellectual property to be before you've already accumulated too much value, and now you have to pay a tax toll on the way to restructuring it. There is no one model that's going to work for everybody, but ask those questions, think about where you want to go as a business. And I'll add one more wrinkle to all of this, which founders always think it's kind of funny, because we're talking about their business. And I asked them about their families, and I asked them about the families of the other owners that are running the business. Are you happy in Canada? I'm using Canada as an example because we're based in Vancouver and Calgary. But are you happy? Are you enjoying the Canadian winters in November and December? And the reason that seems ridiculous is they're like, well, we're trying to talk about business here. Why are we talking about what my personal plans are? Well, if the owners decide to change where they want to be, let's say they want to move to sunny Florida or Dubai, or maybe they're just thinking, I'm building this great business in the US or Europe, I need to be there. I need to actually be there more than just going to trade shows. I actually need to be there and, boots on the ground and build a business and spend significant amount of time. Well, that changes your tax residency. Immigration, totally different story, but just from a tax perspective, there are different rules that define what creates a tax resident. And you don't want to be in a structure where, for example, there's something known as a sandwich structure where you have, Canadian, US, Canadian, or the other way around, US, Canada, US. So US, now you've moved to the US, so you've become a US tax resident that owns a US company that's doing business. Like you have to be very mindful of not having that structure, because if you are a US resident owning a Canadian entity, doing business in the US, you've got a pretty ugly tax consequence to clean that up. So be mindful of it, plan early, and track your days so you know whether your tax residency changes.
Yeah, like to give you an example, we had a client where we're like, just don't come to Canada right now. You can't do it because your structure can't handle it. You're going to pay double the tax. And he's like, no, but I found a wife here. I'm going to move here. I have a girl. She's my girlfriend. Can I live on my father's boat? And we're like, no, you just be there. Just make sure you're there and you ask for most of your time this year, and then you can move next year when we can plan for it. So that's what we help people out with, is we look at your situation and say, it doesn't work right now, but we can structure around it and probably make it better for you.
Yeah, and I would say, just to answer that first question, hey, Namir, Savneet, what's the best structure for me? I would say the best structure for you is going to be the one you don't need to unwind later, the one that gives you that flexibility for where your business is headed, not only where you are today, but also where are the owners going and what do they want to do in the future.
I think you missed a slide. One more. Oh, it's going the other way around.
Back to.
One more.
No, back one more. There you go.
Okay, we found it. All right, now you've decided what kind of an entity or structure you need, right? So how do I send money down to that structure? So say I'm a Canadian company, I have thought about, okay, I'm going to have a corporation in the US. So do I send the money down as an equity, or do I send it down as a loan, right? So I say, okay, let's do a loan. What does that mean? It means that your US company needs to pay interest, right, on that loan. And it's important that that interest is at arm's length, right? You can't just do it for free, right? And again, the interest can get deducted on the US entity only if it's paid. So if all you're doing is accruing, it's actually not a loan, it's actually equity. So it's super, super important that when you structure stuff or plan to send money down, you have to think about, can the US company actually make the interest payments, right? So in a way, it's good for the US company because then your profits in the US go down when they pay the interest and you pay less American tax on it. But then there are other limitations on interest too, and the new law, the big beautiful bill, I'm sure everybody has heard about it, that changed the rules, right? So the interest is limited to 30% of your EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Did I get that right?
Yeah, you did.
Yeah. So, and so you can deduct higher interest in the US, right? But the caveat is you have to pay it. So the question is, did they pay it or not? So if you can afford to do that, then yeah, loan's probably a better answer, right? But what does that do to your debt equity ratio? Will your investors like you having more debt on your books, right? Right? So all that matters. And then for equity, you send the money down, it just sits there, right? It doesn't get you a deduction, but in a way it's better for you because your US entity cannot actually afford to pay the interest. So you have to decide, how do you send money down to your subsidiary or the entity that you want to do business in other countries, right?
Yeah, just to add to that, again, a lot of times when companies are dealing with related entities in their corporate structure, they're thinking, this company's paying that company. It's, everything is kind of penciled and diarized in my books in a certain way, but we're not going to document this. We're not going to document this, for example, as an actual loan, or am I going to actually do any real payments or cut a check, because it's the right hand feeding the left hand. It's all the same. It's there's no impact. And the reality is the IRS, using the U.S. as an example, will say, well, if it quacks like a duck and it's walking like a duck, I'm not sure we're going to treat this as an actual loan. I think you're actually just financing your expansion globally using equity, not real debt, because you're not paying this off. And the challenge with that is then when you're like, well, I want to pay my loan back. I'm going to get some of that principal back. I'm going to get some of that interest back because we need the money back here in our home base in Canada. The IRS can look at that and say, well, we're not going to let you do that without any tax consequence. We're going to treat that as if you're paying yourself a dividend. And so there's a leakage of tax that goes to the IRS that you actually can't get back. And so that could be 5% or 15%, depending on how much of an ownership you have in that foreign entity. So it's something to be wary of. Again, you're growing the business, you're focused on all these other variables, but be mindful of how you're documenting this. The documentation is pretty critical.
Yeah, and now think about, so you're Canadian, and now you have a US sub, but you're actually sitting here and helping your US, or you're helping the business for your US subsidiary. So where does your time go? You're actually getting paid by the Canadian company, right? But can your US entity actually get a deduction for what your time is worth, right? And that's what transfer pricing is, making sure your expenses sit in the right entity, right? So if you're Canadian, an employee of a Canadian company, but then they're actually working on something related to the US subsidiary, the US entity can actually pay the Canadian company for your time, right? And so that's super, super important, and so that you can bring the profits down in the right entity.
Yeah, so transfer pricing, if you hear that often in the world of expanding a business, it's essentially an economic modeling where you're deciding how to allocate price, costs, and do that between the related entities. And it has to actually reflect the economic reality of how you're doing business as if it was at arm's length. So it's as if you were transacting with a unrelated entity. And if it's not done that way, and you have to make sure you're updating those, it's contemporaneous documentation you have to have for those transactions. The tax authority in the countries you're dealing with could come back and challenge that and say, well, you know what, nope, this should have been at this rate, or you should have been charging this amount for this transaction, which otherwise an arm's length transaction would have.
Oh, the other way. No, you're good. Yeah. All right. So I think, what do investors look for? So you've grown your company big, and now you want more investors. So what are they going to do? They actually, when an investor is coming in, they look for a lot of stuff. Like, what have you been doing in the past 5-6 years, right? Like, I think the slide changed. It should be. Yeah, that's the one, right? So do you have any foreign activities? Does your company have foreign activities? Did you actually file the right forms? Are the taxes withheld properly? Did you pay your taxes in the right state, if it's in the US, or the province, if it's Canada, right? All that stuff. And then your documentation. So remember we talked about transfer pricing on the last but one slide? And do you have the documentation for it? Is there a legal agreement that can actually state how much your transfer pricing fee is? So that's like super, super important, right? And then where is the fee getting charged? If there's a merger, there's an acquisition, how was it accounted for? Where did the cost for it sit? So it's like super important for any investor who's coming in, and you need proper documentation for everything, whether it's your returns, where did you pay the tax, how did you pay it, and how did you come up with where you owed the tax, like the basis for it, as well as legal agreements.
Back one slide, I think.
I think that's it.
There we go, yeah. So another debated question is, when you're setting up this global business, where should my profits reside? Where should they actually live? And so the question I want you to think about here when you're building a global business is ask questions like, where are the key functions actually being performed? Do you have, well, the first thing, the concept there is profit follows substance. What does that mean? Well, if you have employees that are doing key functions, or they're doing the R&D piece, or they're doing activities that generate value for you, that is probably where you need to allocate some of the profits. Look at the functions that are being performed. Look at what type of commercial risks that they're assuming. Who's actually bearing the economic and commercial risk? And who's managing those decisions around pricing and the risk assumed in each of the different markets you're going into? And with the assets that you have in the different businesses, who actually owns them? Who actually controls them? Where are the strategic decisions being made? Are they all being made here in Canada, or are they being made outside of Canada? Who is managing the pricing and the customer relationships? You know, all these type of questions. I say that because a lot of times companies will tell me, well, all these things are happening outside of Canada because we've now scaled the business, but I'm still going to allocate most of my profits to go back to Canada. And the challenge with that is the tax authorities are going to look at that and say, that's not actually aligning with your economic reality. So, easier question to answer early in the business, but as you scale, and you know, it's more than just having a remote sales employee. Now you've got some, you know, some key functions and strategic decisions that are being made. The assets are controlled and owned and managed outside of your home entity, your home jurisdiction. Then your profits need to actually be allocated to reflect that. The thing about transfer pricing is you're managing that reality and you need to review it as your business evolves. So if those facts change, any one of those facts in terms of IP ownership, strategic decisions, where the assets are controlled and operated, then your transfer pricing likely needs to be updated as well.
Yeah, so just to give you an example, so say you're the owner who started this business and you're making all the decisions here. So there was a management fee going from the US company to the Canadian company in our earlier example, but now you've changed, like, I'm big enough, I'm gonna hire a CFO who's gonna sit in the US. It's going to change the answer. It's going to change what that amount of deduction for transfer pricing looks like, or the income on this side of the border is going to look like. So everything should reflect your economic reality versus, so your answer that you had in the first year of your business is very different from the fifth year of your business. So as you evolve, it's important to look at where the profits will live.
Yeah, and sometimes people use labels that they get very comfortable with early on in the business, and they say, again, let's assume you have a U.S. subsidiary, and they say, well, that U.S. subsidiary, they're just doing, they're a limited risk distributor, or they're a service provider for my Canadian business. Okay, let's actually look at the functions of each of the people that are performing anything for your business. Who is actually doing product development? Who is actually managing your customer relationships and driving the business, driving value for you? Those are the type of questions where if the economic reality doesn't match how you're allocating the profits, again, it's not going to stand to be defensible in any of the tax authorities that are looking at it. And the reason all this matters is when you look at how you're allocating profits, that's going to impact, where is cash being distributed from? Are you going to be subject to withholding taxes? Are there clean and efficient ways to repatriate your profits out of the business? Foreign tax credits, if you want to make sure that you're not getting double taxed, so if you're in two different jurisdictions and you don't want to get dinged twice, part of that is making sure that the foreign tax credits are going to be available for the income based on how the profits were allocated.
So just to give an example, right? So if I'm a Canadian company, I decide I'm not going to do business through a subsidiary, I'm going to do it directly. So the Canadian company might end up paying tax in the US. So that tax that the Canadian company pays in the US is available as a credit when it files a Canadian tax return. Because in Canada, you will pay you will calculate your tax on worldwide income and then you get the credit for that. So that's one step. But then if you are in a structure and the hybrid entities that we talked about that are treated differently across borders or different countries, you might not have that available. So that means you're paying a tax in US and then you're paying a tax in Canada as well. So it's super important that your structure is right when you begin, right?
And it's not just because you're worried about the boogeyman tax person. You're also thinking about, hopefully as a founder, what is your final exit strategy? You know, are you looking to do an IPO? Are you looking for an acquisition? And I can tell you that the investors are going to be very vested in knowing that you've been thoughtful on how profits are being allocated and they actually match your economic reality. They want to know that if you're saying your IP is in, you know, country X, is a lot of the value being generated and derived in your business coming from country X. So it really does have an impact on the perception from investors and buyers to know that you've been thoughtful very early on in how you're designing your global structure.
I think we can skip this one. Yep. You got it right. Go ahead, Namir.
Awesome. So just to kind of reiterate some of the things to be considerate of as you're building your business, you know, think about what are your plans, not just today. Don't take the current snapshot. Think about where you want to be in 5 years, 10 years. Like, are you going to be hiring global talent? Are you going to be looking for rounds of financing from US investors, from European investors? All that will impact not only who owns the company, but who ultimately should be controlling the company. And again, if you're thinking about changing your own, you know, plans of where you live, are you going to stay in Canada? Are you going to move to another country? Are you going to scale to another jurisdiction? You know, be mindful of your personal plans, especially if you think as a founder, I need to be part of where this business is going. I can't build it remotely from my office in Saskatoon. Then you know what? That probably means you need to be mindful of your tax residency will change as an owner. Your structure needs to be revisited to make sure it's still a very efficient structure to do a global business.
Yeah, and I think deciding where you want the investors, right? So you can build a structure today, and as a Canadian, it's easier to get a Canadian into a Canadian structure. But if you're planning to go like, no, I'm going to go global. I'm going to have investors from UK, Europe, or America, right? So what can you do for them or create a vehicle so that when they come in, it's easy for them to, hey, I'm going to just be a partner in this partnership, instead of you trying to unwind everything and say, this works for everybody, right? So think about it from the start. And I think especially once you're big enough and you know that you need investors, start thinking about, okay, where do I want the investors to come in from? Which entity should they come in from? Or is there a vehicle? When I say vehicle, it's an entity, which works better for a person from, say, US or UK, whereas it doesn't work for a Canadian. So can I structure it in a way that I keep all the tax efficiency on the Canadian side, and they get to keep the tax efficiency from a UK or a Europe or a US perspective?
Yeah, the other thing I want to add to that is, you know, hopefully as you scale your business, probably one of the first structuring decisions is going to be, you're going to get another legal entity set up, perhaps in a different jurisdiction. When you do that, I can tell you one of the most common mistakes we see, you know, as the cross-border tax advisors is the messiness in the financials on this, because from an owner's perspective, it all consolidates into one, right? So I have one consolidated set of financials, everything rolls into it, everything looks the same. But you actually really need to be very clear in your legal and economic boundaries of, okay, you have more than one entity. What is this entity doing? Which entity is actually the one employing your people? Which entity is the one actually contracting with customers? Like, oh, I'm using my Canadian entity name because that's the headquarters. But is the Canadian entity actually the one that is contracting with your customers? So we've gone as far as telling clients, we actually need to see your invoices. We can't give you good cross-border tax advice unless we know you really are making those very clear lines between what is each entity doing, who is hiring who, which one is the one that is actually contracting with customers in the different jurisdictions.
Yeah, so just to give you an example, we were actually dealing with something very recently, and this guy was like, this guy is an employee of the US company, and we were like, okay, show me your agreement. And guess what the agreement said? The person in the US was actually employed by the US company. Guess where the payroll expense is going to sit? It's going to be in the Canadian company and not the US company, and then you got to figure out if there is an intercompany charge that needs to go around. So making sure the agreements are in place and it's for the right entity is super important.
You're essentially, think of it this way. If you step back, again, go away from the taxes, Allow yourself to be in the mindset that my legal and operational reality need to align. And if that sounds vague, then start asking questions. Because those are the questions you want to ask early on before things get messy and you have to clean that up, or you have, in the worst case scenario, some tax authority auditing you and asking questions for you. The other thing is make sure your structure is financeable. And what I mean by that is, at some point, hopefully you're thinking about your next fundraising round, you're thinking about your exit, whether it's, you're going the venture capital route or you're going IPO, and how you're financing that is going to matter. They want to make sure that you've aligned, again, that operational reality in each of those different entities. So they say, this is why we're financing this. And you want the structure to be a structure that can accommodate that. So if right now you have a Canadian business and you've got Canadian owners or you have Canadian investors, maybe at some point you're going to start thinking about, do we need US investors? Do we need to have other investors from other jurisdictions? That might really change not only what is the right structure for you, but also questions around, for example, in Canada, we have what's known as a long-term capital gains exemption. And that's available for you if you are a CCPC in Canada. And so from that perspective, you want to be very conscious of those questions so that, if you're going down that path of getting another investor, how valuable is that long-term capital gains exemption for you? Now, in the US, you have something kind of similar. It's called QSBS, sorry, a lot of acronyms. But again, it's just a different way to be able to sell a US corporation and get an exemption there on the sale for the capital gains. But all those are questions you have to be mindful of when you're looking at how am I financing this and how do I eventually want to exit? And I'll leave this with one last thing, which, as an accountant, I almost have to do this, be mindful of your documentation, really do have, and we're not just talking about transfer pricing, you can scale your way into that. You can start with something very brief, an informal memo to get you kind of into a place where now it's mission critical. You actually need a formal transfer pricing document. But also look at your board resolutions. Look at your payroll registrations. If somebody is working in a different jurisdiction, make sure you're registered in that jurisdiction. If you have, you're operating in different places that you haven't registered that business, be mindful of that. All those have an implication, especially when you're looking at due diligences or an M&A transaction. I can tell you a lot of times businesses have their T's crossed and I's dotted. They have a lot of things figured out. But then some of the small details, whether it's a state exposure or payroll registration or their transfer pricing, is what ends up making the deal fail at the 11th hour.
So if I were to sum up all that we talked about, and we talked about quite a bit, I would say get your structure right? Look at your structure, get your books right, and get your documentation right. So if you make sure all these three are right, it's super easy to get investors. Of course, they're going to go to the due diligence. There's a lot of time spent there, but at least you have your ducks in a row. So when an investor comes in, it doesn't feel like an ordeal, especially from a tax perspective.
Yeah, and one more thing to add to that is allow for some flexibility in how you're building your corporate structure so that as your story evolves, as the company evolves, you're really being mindful about preserving the wealth and the value that you're trying to create, the legacy you have in this business. Because you don't want to have an ultimate exit from the business that has somehow put you in a situation where you've lost that wealth, you've lost that value you've built in the business. And the earlier you're mindful of this, the better outcome you have on the other side of it.
I think we're on time.
Thanks, guys. We've got a booth, by the way, at E140. If you want to book any sort of 15-minute consultation with us to ask cross-border tax questions, please go ahead and book. Our tax team's here to help you out.